The Economic Update with Tatiana Bailey.
In today's update, consumer sentiment and stock market numbers aren't always on the same page.
Right now, Dr. Bailey joins us to break down this contrast.
I've been fascinated by the continued rallies in the stock market, especially compared to consumer surveys that show caution and pessimism about the U.S. economy. Key indicators are telling us conflicting things. Let's start with consumer spending, which appears robust despite souring consumer confidence. A recent study showed that the top 10% of American consumers comprise fully 50% of all spending, high by historical standards. Remember, 2/3 of GDP is consumer spending, so 1/10 of our population is driving a large share of our economic growth. The question then becomes, what about the other 90% in terms of household income and spending? With the government shutdown and the halting of economic data, I wanted to share some non-governmental statistics that give us a clue. Sales of very cheap food items such as canned tuna, rice, beans, and macaroni are all up this year. Hamburger helper sales have increased 15% through August, and Yelp searches for cheap eats are up 21%, all meaningful indicators of the spending patterns of middle and lower income households. Given that food at home has increased roughly 26% since early 2020, these trends aren't surprising. Similarly, Google searches for help with mortgages have surpassed Great Recession levels. 1/3 of adults in the past year say they've opted out of needed healthcare due to financial constraints. That's up from 9% in 2023, according to Prof G Markets. Even for those with health insurance, deductibles in the thousands and hefty copay percentages remain barriers to care. Yet the stock market rallies on with near logarithmic increases over the past couple of years. There is talk of a bubble that may pop, given that over half of S&P 500 gains have come from the top 10, mostly tech-related companies, fueled primarily by AI. This means that other 490 companies performed at fractional levels. Many economists state that the AI boom is a large portion of the growth in the nation's GDP, also creating the illusion of outsized economic growth and resilience. So, we know the average American is cutting back and feels cautious. But should the stock market have a major correction, that top 10% who buys 50% of all goods and services could also cut back, creating an economic compression from the top and bottom. Next week, I'll talk about why there is talk of an AI bubble.